So today we're going to cover what the strategy I would use if I was starting out in real estate, what the risks are, and how to get a loan from the bank. There's a couple of questions that it doesn't matter, if I'm speaking somewhere or people reach out on DMs, but there's a few that come up just over and over again. One that I would get asked the most is, how much money do I need to start investing in multifamily? I think the first thing you need to do when deciding if you're getting into real estate investing or multifamily investing is understand what your strategy is, right? Because you can get a 5% down loan if you're going to do buy and hold, or if you want to do more of a flip or a value add, you might have to put 30% down. So that drastically changes the amount. I think if you saved up, $100,000, that is a good starting place. If you're doing buy and hold, it's probably not enough if you want to do value add, unless you're going to do pretty small. If you're going to do buy and hold, 5% down on $1 million is $50,000, and that still leaves you $50,000 as a reserve to cover all the extra expenses. I don't even know if I would leverage quite that high. I would probably do, maybe an $800,000 building, put 5% down. You still have a nice reserve fund if things come up that you can cover it. The other thing to keep in mind, though, is you have to have a certain net worth. So depending on the loan you take, if you just have $100,000, the bank probably isn't going to give you the 95% down if that's your whole net worth. A lot of people teach, just raise money for your first deal and go way bigger. I don't necessarily agree with that. Maybe I would have, before I ever got into the industry, but I think you should do the first one by yourself and figure out, because there's so much stuff that you're not going to understand at the beginning. There's so many expenses that are going to come up. The actual operating statement versus the pro forma you run when you're looking to buy the building are going to be drastically different. So you want to understand all those expenses before you have the, burden of taking other people's money. So unless it's a really, really close friend that wants to do it with you and figure things out, or it's, a family member, you could maybe raise some capital and do a slightly bigger deal, but your expenses are going to be that much bigger too, right? There's always things that can come up. And if you have 20 units instead of 4 units and you have to change something in each unit, that's a lot bigger expense, right? So I wouldn't go too big too soon. I think if you have, like I said, if you have the 100,000, look for that 6 to 10 unit building and leverage it. But if you're doing value add, you're going to need a lot more money. If you need 30% down, and then you have to do the actual value add, which is where the expense is going to come in. If it's $10,000 a unit, that could be another $100,000 you'd need. So I think the most important thing before you, come up with the amount is decide what your strategy is going to be. So for me, I probably wouldn't do value add at the start. I know it's exciting because there's the potential of putting in a little bit of money and pulling a bunch of money back out in a year or two. But for your first deal, there's so many moving parts, right? And you usually are going to have a timeline. You're going to take a bridge loan or temporary debt for a short amount of time and try to do all the renovations, get the rents up. And if any one thing goes wrong along the way, you might have to put a lot more money in. So I would look for a stabilized building that you can just hold long-term. Put long-term debt on day one. It's very, freeing to have, if you have a 10-year loan or a 5-year loan and your payments aren't going to change for that amount of time, it makes it a lot easier to go in and stabilize that building. And, you just have the comfort of knowing what your mortgage payment's going to be for the next 10 years. So you don't have to worry about in 2 years, we have to have rents up this certain time, and you're trying to get tenants out and get new tenants in and decide what renovations to do. So for the first one, you can definitely take some pressure off by doing the buy and hold strategy. If you want to leverage up a bit more, you can go to the 95%, but just make sure you have a big reserve fund there. So the next question that I get all the time, and this is from people who might want to invest with us or do it on their own, but what are the risks associated with multifamily investing? The reason I'm in the space is I do think it's one of the most secure or safest asset classes you can be in. You can get long-term debt. Your investment is generally backed by a hard asset. It's backed by the real estate. If you look at, a 10-year period of time, you can pick almost any decade. And in most major cities, if you're smart about it, you're going to see that trend go up. Most of the time, assets like multifamily go up. They outpace inflation over enough time. So it's a very secure asset. If you get debt, you can get insured debt, which makes a big difference. But there's risk with it too, right? Interest rate risk is one of the biggest one. In a market like today, pretty much the value of everything is based on the debt you can get for it. So in Canada, that's why we, even though interest rates went up, we didn't see prices come down, was because they had now allowed you to amortize it over 50 years. and put only 5% down. So it really saved a lot of people. But the interest rate and the debt market is one of the biggest risks I would say there is. Now, if you take 10-year debt, you don't have that risk for 10 years. But if the government just came out tomorrow and said, instead of giving allowing 50-year loans, we're only going to allow 30-year, the asset values would go way down because you couldn't service that debt anymore, right? You'd have no cash flow. So the reason most people who bought property in the last 2 years, let's say, could do it is because they were taking 40 or 50-year amortized loans and they were putting in a very small amount of money. Other things, oversupply. So you'll see this in some maybe American cities where there's just so much supply come online that it actually, it brings down the value. In Canada, maybe you see it in downtown Toronto with, 1-bedroom condos or very specific areas, but it just, our building process and everything, it moves so slowly here that unless we drastically decrease demand, it's going to be hard to catch up on supply, even if we have lots of units coming in. But that can be a slight risk. So the reason with my model, I like to buy older, we call them stabilized value add. So they're, maybe built in the 70s, 80s, and we can put long-term debt on day one, and then the value we can still do renovations and stuff over time. I like that product because you can pick that stuff up at maybe $150 a door to $200 a door, $200,000. And to rebuild that unit is going to be $360. So you're still way below replacement cost. So what I always say is even if someone comes and builds right next to me, builds a brand new building and they pay $360, they're not going to be able to charge the same rents that I do with a unit that cost me $150. So you're kind of secure, as long as you're buying well below replacement cost, you have some cushion for that risk. If you're buying brand new product, that's definitely a risk where someone can build a building right next to you, a huge building, and then you can have a price war because you both have kind of the same cost base. There's, I guess, a lot of things that are just out of your control that can happen. If the economy goes really bad and we have a mass exodus out of a city or out of a country, and that can always be a risk, right? If you underwrite, like right now, let's say the market vacancy is 2 to 3%, and that's kind of what you're expecting when you underwrite for the next couple of years, and all of a sudden vacancy goes to 7 or 8%. That's a massive impact on your finances, right? That's a huge, usually for sure, if you're taking a high leverage loan, you don't even have that much extra cash flow. You don't have that cushion there. So vacancy is something, it can be mismanagement if you get a bad management company in there, if you don't know what you're doing. It's very easily, for sure on smaller properties, if you have a 10-unit building, it's not hard for 2 of those units to sit empty for a couple months. Well, that's 20% vacancy, and you probably underwrote 2%. So when you're new at it, a big risk is understanding, things like vacancy and all having reserves to cover all that risk. But vacancy can be a big one. With real estate investing, I always believe if you can just hold on, if you can weather the bad times, insurance might go up and it'll come back down. It's cyclical. Vacancy might go up or come back down. Same with interest rates. As long as you have the cash and the staying power to hold long term, you'll do good, right? Because maybe it flushes some of the weaker operators out of the market and the stronger ones stay. They get opportunities to buy, right? When there's blood in the street, that is when you should be buying, even if it's your own. But that's hard to do if you don't have cash. So you need to have enough reserves that you can weather the storm. And if you can hold on to real estate long enough, it's generally always going to be a good investment. So yeah, whether you're doing it for yourself or trying to raise capital, risk is something you have to look at and is always going to get brought up. So, a couple things we covered there. Interest rate risk, that's going to be a big one. Kind of the intangible things like insurance or electricity costs, things like that. Vacancy rate is always going to be one. And then another thing, which is, you can't really control, but you can kind of look ahead or back and see what's going to happen, is something like the economy. That can have a huge impact on you. Another question I get asked a lot is, maybe you've bought some single family and you want to jump into multifamily, but you don't know, how to get financing. You don't know how to get started, what the banks are looking for. So one thing that I think is somewhat of a myth that's out there is that they don't look at the person at all, and it's just based on the income statement of your building. Now, that's definitely true a little bit, but the bank still will want to see. They'll want to see a certain net worth, or they're not going to give you the loan. For sure, if you're buying bigger stuff, they'll want to see that you can actually have managed something before, or you have some skills that can translate to managing the building. or else they're gonna make you get a third-party manager. So for a lot of new people, they want to do it themselves. You have to kind of show that you can, because the bank doesn't want you to just buy this building, run it into the ground, and they have to take it back over. And they're going to run your credit. I don't know exactly what the criteria is for giving it to someone, what the credit needs to be, but you do need to have good credit. You're still, depending on the loan, but you're still going to probably be signing, some kind of guarantee on that debt. So if you're someone with no assets and no credit, that means absolutely nothing. So they want to see credit. And then from there, it's going to be based on the building too. So I always tell people, when you're looking at properties that are listed on MLS, maybe you're just going to see a pro forma. It's going to look great. You have to understand how, if you're going to go through CMHC, you have to understand how they underwrite, because it really doesn't make any difference if that owner, doesn't charge a management fee or he charges 2%. They have a market rate, so they're going to underwrite at 3.5% or 4%. They're going to underwrite $50 per appliance per unit, right, as an expense. There's all these things that you have to understand, because you might come in and make an offer based on the seller's pro forma at $2 million, and the CMHC might say, hey, we're only putting a value of 1.7, and we'll give you 95% of that. So now instead of you putting in 100,000, you're putting in 450,000. So those are things you have to understand, the underwriting process. I always recommend to people, there's a fee associated with, but use a broker that has done deals before, CMHC deals for sure, because there's a lot of stuff that you don't know, and they're doing this all the time. They understand what the bank wants to see. They can help you get, your net worth statement. The bank's going to want to see, the value of your home and your investments and all these things that they're going to be able to help you get around. And at the end of it, if you don't do the deal, there's generally no fee to use a broker. If you do the deal, it's going to be a small percent. It's not going to be a huge amount of money for sure on a small deal. For sure, for your first couple, I'd use a broker. And yeah, get your house in order. You'll want to show as much net worth as you can. You want good credit, and you need that net worth to be a certain amount of the building. So for starting out, going to the bank, you need a net worth and assets. And if you don't have it, maybe you have to get a family member or pay somebody to sign on and take the risk of that loan. But you're going to need that. You're going to have, either some experience managing the building or a third party that's going to do it, or be able to prove, have some skill that translates into that. And then you need to have a pro forma that's underwritten to so you can get the same value that they're getting, right? You can't pay any amount you want for a building. They're not going to leverage it at that. So you have to have a pro forma that matches the way they're underwriting. Those would be the three things. And, I think if you have those three, you'll have a pretty good shot at getting a loan. So today we covered some questions that I get pretty frequently. Starting out, trying to buy your first property, you need to get a strategy first. That's the most important thing. Understanding the risk, that's big, whether it's you or you're telling it to an investor. And the third thing is how to get the loan. So we covered those three things. If you guys have questions that you want to ask, send me a DM or an email, and we can cover them on another frequently asked questions episode. We'll see you guys next week.